Hey, badass business owners, I know you want to make more money in your business. So what we're going to do today is we are going to go over 2 reports that every small business owner needs to understand. And this is your profit and loss statement and your balance sheet. Now, you might be wondering, why these 2 reports? Well, let me tell you, these 2 reports really contain the information you need to not only see how you're doing as a business owner, but also to let you know what you can do to become a better business owner. So the first one is going to be your profit and loss statement. And basically, your profit and loss statement is letting you know about the flow of money into your business and out of your business. And we're going to take a closer look at it here in a second. The second report that you want to make sure that you're looking at on a monthly basis is going to be your balance sheet. This is what's going to show you what your business's assets are, what your liabilities are, and ultimately what equity you as the business owner have in your business. Now, when they work together, like I was saying earlier, they actually tell you the health of the business and how well you're doing. Because sometimes your profit and loss might say one thing and your balance sheet says something else, or vice versa. Now, let's take a look at each one of these. So the first one is going to be your profit and loss. And this is probably the one that you're most familiar with because of whatever type of bookkeeping that you do in your business. And it's basically tracking the money in and out of your business. Now, the best way to think about your profit and loss is by using the number one calculation that I'm always preaching to you guys to remember. And that is sales minus cost of goods minus expenses equals profits. It's the flow of money, right? You take money in, you're going to go spend your money on the cost of goods to do the product or service that you sell, and you're going to pay the expenses of the business, and finally you're going to have the profit left over. If you can remember that, you can understand the flow of money on your profit and loss statement. It's broken down into these 4 categories. So the first one is going to be your income section. Your income section is going to show all of the money that you take in, all the different sources of income that you have. Sometimes you'll see a negative in there, like if you give refunds or rebates or returns and stuff like that, but because it's basically still income coming in and out, and that's going to be in that top section. The next section is your cost of goods sold. Now, keep in mind, some of you may not really have cost of goods, but most of you have some sort of cost of goods, because your cost of goods is any money that you spend to provide the product, to make the product, all right, or to provide the service. So for example, if I'm making candles, I have to buy the candle, or I have to buy the materials for the candle. Those are going to be cost of goods. If I install water heaters, I'm going to have to not only buy the water heater and the parts, but I have labor also associated with that service, and that would also be cost of goods. Just like if I did the candles and I had to make the candles, there's going to be some labor. I do other videos where I break this down even more when it comes to cost of goods and understanding it, so make sure you check those ones out. But for today, just know that on the P&L, you have a section dedicated to your cost of goods. Now, the next section is going to be this one little tiny line here that I don't want to skip, and that is going to be your gross profit. And that line is all it's doing is it's taking the sales that you've taken in and minus the money that you've spent to provide that product or service, being those cost of goods. And that's going to give you what's called gross profit. And this is your profit prior to you paying the other expenses that the business has in our next section. The next part is going to be your operational expenses. This is basically any other money that you spend to run the business. This is going to be your advertising. It's going to be your training. It's going to be your insurances. It's going to be anything else that you could possibly spend money on that isn't directly related to your cost of goods. And this one is going to be a long section, not necessarily always with tons of money, depending upon how you run your business. But if you have rents and some other high things, yeah, those could go up. But most people don't have high expenses, especially when they're a newer business owner. But that's where all your other business costs are going to go. And then finally, you're going to get down to your bottom line, which is your net operating income. Otherwise, what we all like to call it is profit, right? But I do want to point out that your profit doesn't mean it all goes into your pocket. I talk about this on other videos as well. Your profit has 3 jobs to do, right? It has to pay your taxes. It has to be put back into the business to pay other things that you need to pay for. And it's going to cover any money that you take out, which is your owner's draw. Now, where a lot of people get messed up is they think that their business should have this amount of money in your bank account. And that is not always true, because you have other things that your business has to pay outside of that. And we're going to talk about that here in a second. The best thing you can do is think of your profit and loss statement as your business's report card. Okay. Now, what are some of the benefits of you looking at this P&L? Well, the first thing is it's going to tell you how you did for the month. Were you even profitable? There are people that have businesses that might be profitable one month, not profitable the next, then profitable, not profitable. It really depends upon when something hits. If you have a huge expense, for example, that hits, like an annual insurance payment that hits, sometimes that might knock you out. Or if you have your payroll hits twice in 1 month or 3 times in 1 month versus the normal 2. There's things that can happen. But at the end of the day, it's going to tell you how profitable you were in your business at that time. Now, it's also going to tell you how your year is looking, because now you can see the trends by month. You can see what's going on. Like I said earlier, you can see if you're paying something 1 month but not the next. Where are you spending the most money? It's going to tell you all kinds of good information when you start getting into the habit of looking at it every month. And by the way, when you look at it every month, I encourage all the people that I do bookkeeping for or that I coach that I want you to look at your month, but I also want you to start looking at your year to date. I want you to look at those trends, because 1 month doesn't really tell you everything you need to know when you are looking at your P&L. You really got to kind of look at the whole picture. So look at your month, but also look at your trending months as well. You're looking for some trends as well when it comes to, sales. For example, you want to compare last September to this September. You want to look at how you did the first half of the year this year versus last year. You want to look at how your expenses are going. So you're looking at all those categories, right? Sales. Am I doing better in sales, worse in sales? How are my cost of goods going? Am I controlling them? How are my expenses looking? Yes, I might be up in sales, but my cost of goods aren't going up, which is a great thing. But for some people, your cost of goods are going to have to go up because you're doing more sales. But that doesn't always mean that your expenses are going to go up. If you rent a building and your sales go up, your rent percentage isn't going to go up, and your rent's not going to go up unless you're paying it by sales, for example. But your payroll might go up. So some expenses will stay the same, some won't. So you're looking for those trends, and does it make sense with where things are going? It's a lot of good stuff. I've got other videos, like I said, on the P&L, but I just want you to understand some of the basics as to why that is important to you in your business. Now let's look at the balance sheet. This is the other report, and this is the one that I find a lot of people don't look at. And especially if you're doing your own bookkeeping, a lot of people don't even know to go into the reports and pull this up. And if you do have a bookkeeper right now, you're probably seeing they're including it in the reports that they send you, but most people don't even look at it. But it's important that you look at it. It is a very important report in your business when it's being done correctly, because what it's going to tell you is how much equity you as the business owner have in the business. And this is where a lot of people discover that, hey, I don't have the money in the bank that matches up with the money that I've got coming in. And we're going to talk about that a little bit here in a second. Now, when you're looking at your balance sheet, the first section, it's people need to understand why they call it a balance sheet. And it's really simple, because you have your assets that must equal your liabilities, what you owe, and then plus the equity that you have. So I'll give an example here. If you look at our $100, those are your assets. That's money you have in your hand. You have $100, but you owe $40 to other people. So out of your 100, you have the 40, and that means you have left over 60. So if you think about it, your assets, that $100, to make it balance, I have to take what I owe, the 40, plus the equity that I have remaining, which is $60. So that means that for every $100, or for the $100 that I have, 40 of it is allocated to my liabilities, 60% is allocated to me as the business owner. I know it can get really confusing, but the more you do this, the more you look at it, the more it starts to make sense. So let's take a closer look at this report, okay? So your assets is going to be the top half, and there's all kinds of different assets that are in there. And you've got, short-term assets, things that you can do right away, and things that might take longer for you to sell. So basically what's going to happen is in this section here, you're going to find all kinds of things. So let's take a look at some examples. You're going to have your cash in your bank accounts, any money that you have out there. Some people have 2 accounts, some people have 3 accounts. It just depends upon how you have it set up. If you have money for the business set up in one account to pay for your taxes, that's part of the money that you have in the business because you haven't paid them yet. You might have your operating account, or you might have an account you dump everything into, whatever it is, whatever money that you have cash. Now, remember earlier when I was saying how your profit and loss is showing you made money, but yet your bank account doesn't match that. The next section is going to help you understand that a little bit more. But your assets are also going to be money that people owe you. So let's say you have billed somebody and they owe you $100. Well, that is an asset because you have money coming in. That is money that is owed to you. That is also an asset. Accounts receivable is what a lot of people will call it. You've got your inventory, right? Because your inventory is worth money. So you would turn around and you could sell that inventory and you can convert it back into cash. So your inventory is considered an asset. Same thing with any equipment that you have, vehicles that you have, furniture that you have, stuff like that. Now, there's other things that are in there, but for the average business owner, these are going to be the core things that make up your assets on your balance sheet. The longer you're in business, you might get a little bit more complicated, but for most of you, that's going to work. Now, the next section is your liabilities. And as I said before, your liabilities are money that you owe other people. And sometimes you owe people short term, which means you have to give them the money sometime in the next year. And then other times you have long-term assets, which are ones that take a lot longer. So if I have a loan on a vehicle, I have the short-term piece, which is in this next year, and I have the long-term piece that is over the course of the loan. But I might also have money that I'm collecting. For example, if I have payroll, you temporarily collect the taxes, and then you turn around and you give them back to whatever government agency that you have to give it to, whether it's the state, the county, and or the government. So your liabilities is basically any money you owe anybody, any types of loans, anything like that. When we look at it a little bit closer, some of those examples would be loans that you have. You might owe money to a person. You might owe money to a vendor. You might owe money to your credit cards. You might owe to the small business associate, whatever it is, any loans that you have outstanding, including those credit cards or any other vendors that you might have. It could be payroll that you still owe, because if I have an employee and they worked the last 2 days, I haven't paid them yet, but I still owe them money. So part of your liabilities is any money that you have outstanding that you owe even to your employees, as well as to the agencies and everybody else that you collect money with when it comes to them. Also, your taxes owed. If you have money that is owed on that payroll, it's money that is owed. Anytime you're taking in money for somebody else and you have to turn around and give it to them, that is a liability. Now, here's where I was telling you that your bank account may not always match with what's going on. And a lot of times it's found in these loans. And I've done a couple episodes on this recently, if you want to go back a few, because if I purchase stuff on a credit card, at the time I make the purchase, I am making it as an expense on my P&L. I go out, I buy supplies, I put it on my credit card. Well, at that moment, I capture that charge. But meanwhile, I'm holding the balance that I'm going to be paying over time. So when the month gets done and I make that payment towards that credit card has already been captured on my P&L for those purchases. But now money is now coming out of my bank, because when I purchased it on a credit card, I didn't lower my bank account at that time. I lower my bank account later when I start making the payments on the vehicle, on any of these loans and everything like that. So if you have a lot of debt in your business, don't be surprised that your bank account never matches your P&L, because you are paying on all that debt afterwards, because you accounted for that debt early on, but now you're paying for it after the fact. And that really does kill a lot of people. I am pro being debt free, because as much as possible, because it's going to really help you close that gap. So you really need to use what your liabilities are on top of your P&L. That's why they work together, and it helps explain to you why you don't have any money in your bank account. So once again, you have your assets, money that you have, minus your liabilities, right? That's where all these ones come in. And then that leaves you your equity piece. And really that's where the next section of your balance sheet comes in. This one's kind of a little off, and it's going to show a negative equity. Why does it do that? Exactly why we were talking about earlier, because their assets are not as big as their liabilities. They owe more money than what they have in assets. And you're probably wondering, how does that happen? Easy, because if I don't have money sitting in accounts, that takes away a lot of that. And if I owe more than what I have, I'm going to have a negative balance sheet. Now, a lot of people don't have negative balance sheets, but it does happen, because your balance sheet is really accounting for a couple things. The net income from that profit and loss, that's going to move over and say, hey, this is the money that you should have made. But then you've taken money out. Now, some people have taken money out for their owner's draw, and they've taken out more money than what they've made. So it's going to take that out, and it's going to also have any other money that you've left in the business, what we call retained earnings. And those are typically what's in your, it comes along with tied to those bank accounts and stuff like that. Because you're taking money in, you're leaving some money in, you're taking some money out, you're spending money on different things. So at the end of the day, the equity is what's left. Remember, our $100 in assets minus our $40 in liabilities, it's going to leave us theoretically $60 in our equity. So your assets has to equal those two combined. And that's where a lot of people get in trouble, like I talked about. But that's just kind of an overview of what it is. And we already answered this question. Can you have a negative equity? Absolutely. If you owe more money than what you're making, you're going to have a negative equity. And I'm going to tell you, you're not going to be in business very long. Because ultimately, if you owe more than what you own, the business isn't going to be able to sustain itself. It is a problem. And this is exactly what we were talking about, why some businesses show a profit on their P&L, and yet they still don't have any money. And it's really, really important that you are reviewing both of these reports. Because like I said, your profit and loss income statement and your balance sheet are two of the most critical pieces of information that you have in your business, because they are helping you do that. And one of the things that you want to look at is, do I even have these reports? Am I even using these reports? And if you don't, you want to make sure that you're using a good bookkeeping system, because it's going to give that to you. That's one of the reasons why I recommend QuickBooks Online. I think it's very easy for anybody to pick up. And, and if you don't like bookkeeping and you'd rather just do your business, that's why you hire folks like me, people who are bookkeepers who can help you get that done. So that way you can work on your business and then they do it. I know for like my clients, at the end of the month when we get all their stuff done, I like to tell them, I kind of pull out the stuff and highlight to them what happened, just so they know exactly where to go pin in on and look at what's going on and what's happening and the trends that I'm seeing. Not that I'm perfect, not that I'm going to catch it all, but I do at least start them down a path to be able to use it. So please, in your business, please start using your profit and loss and your balance sheet to give you the information to help you make more money in your business, to know where the money in your business is going. I promise you, you're going to run a much better business. You're going to be a lot more profitable. And with that, I hope this video has helped you out. And if you like it, make sure you hit that like and subscribe, and make sure that you don't miss out any other videos. We're going to do even more stuff here in the coming months to help you understand your business numbers better. With that, I'm out of here, and I will talk to you later. Bye for now.